In the annals of economic history, a persistent misconception has shaped how societies perceive prosperity. The belief that accumulated funds alone define achievement. Yet, examining the rise and fall of fortunes across eras reveals a stark contrast. Individuals and nations with immense monetary holdings often found themselves destitute amid crises, while those prioritizing enduring contributions through innovation, resources, or expertise forged legacies that withstood turmoil. This exploration uncovers why pursuing mere financial figures frequently leads to vulnerability, and how genuine worth rooted in utility and resilience offers a more stable path. By delving into pivotal moments, we see the human toll of economic missteps. From the anxieties of indebted farmers to the shattered ambitions of over-leveraged traders. Consider the Roman Empire, where currency debasement illustrated the fragility of monetary wealth. During the 3rd century CE, emperors like Diocletian faced mounting pressures from military campaigns and administrative expansions. To finance these, they progressively reduced the silver content in the denarius, a coin once prized for its purity. Merchants who had amassed stacks of these coins watched helplessly as inflation eroded their savings. A family in Pompeii, for instance, might have hoarded denarii to secure a future dowry or retirement, only to find that rising prices for grain and olive oil rendered their holdings worthless. This debasement not only fueled economic instability, but contributed to broader social unrest. As trust in imperial institutions waned, over time, those who controlled productive farmlands or trade routes in essential commodities like wheat maintained their influence, highlighting how true value lies in assets that fulfill ongoing societal needs, even as monetary systems falter. Shifting to early modern Europe. The opulent reign of Louis XIV in France exemplifies how extravagant displays masked underlying weaknesses. In the late 17th century, the Sun King's court at Versailles became a symbol of absolute monarchy, funded by aggressive taxation and colonial revenues from the Americas and Asia. Nobles vied for favor through lavish expenditures on imported luxuries, such as exotic spices and fine textiles, while peasants bore the brunt of fiscal burdens, often facing famine amid poor harvests. This imbalance bred resentment and inefficiency. The clergy and aristocracy enjoyed exemptions, leaving the crown reliant on loans and plunder from wars. By the early 18th century, financial strain prompted the appointment of John Law, a Scottish economist who introduced innovative but risky reforms. His establishment of the Bank General and promotion of the Mississippi Company aimed to alleviate debt through share issuance and paper currency. Initially, this sparked a speculative frenzy. Artisans and merchants borrowed heavily, dreaming of quick gains from promised colonial riches in Louisiana. Families pawned heirlooms to invest, fueled by optimism yet shadowed by uncertainty about unproven territories. When overvaluation became apparent in 1720, the bubble burst, triggering runs on banks and widespread bankruptcies. Ordinary investors, including widows relying on modest stakes, lost everything, while landowners with tangible holdings in vineyards or mills adapted by bartering goods. This episode underscored a recurring cause-effect dynamic: speculative schemes, driven by short-term ambition, amplify booms but precipitate devastating collapses, affecting generations through inherited poverty. Echoes of this vulnerability resurfaced in the 20th century, particularly during the Weimar Republic's hyperinflation in 1923. Post-World War I reparations, imposed by the Treaty of Versailles, crippled Germany, forcing the government to print money recklessly to meet obligations. Workers in Berlin factories received wages that depreciated hourly. A laborer might rush to spend earnings on essentials before prices doubled, evoking a sense of constant dread and helplessness. Families burned banknotes for heat as their nominal value plummeted below that of firewood. This chaos not only dismantled middle-class savings, but fueled political extremism, paving the way for long-term instability. In contrast, individuals with access to foreign currencies, gold, or rural properties preserved some stability, trading produce for necessities. Similar patterns emerged in Zimbabwe during the 2000s, where land reforms and unchecked money printing led to inflation rates exceeding billions %, leaving pensioners destitute and farmers bartering crops amid fear of starvation. Venezuela's 2010s crisis, triggered by oil dependency and policy missteps, saw professionals emigrating en masse, their salaries worthless against imported goods shortages. These cases reveal how leaders' desperate measures, often born from geopolitical pressures, devastate everyday lives, eroding trust in systems and prompting migrations that reshape demographics over decades. Across the Pacific, Japan's asset bubble in the late 1980s offers a modern lens on this divide. Fueled by post-war reconstruction and export-led growth, the nation's economy soared, with loose monetary policies encouraging rampant speculation. Corporate executives snapped up international icons like New York's Rockefeller Center, while Tokyo's property market inflated to absurd levels. The Imperial Palace grounds alone rivaled California's entire real estate value. Young professionals, enticed by easy credit, invested in stocks and homes, harboring ambitions for secure retirements amid a culture of corporate loyalty. Yet, underlying issues like overcapacity in manufacturing and demographic shifts loomed. The 1991 crash, prompted by tightened interest rates, wiped out trillions in paper wealth. Suicides spiked among indebted salarymen, and families grappled with unemployment's stigma. Long-term stagnation, dubbed the lost decades, ensued, with deflation hampering recovery. Japan's resilience stemmed from its core strengths, a skilled engineering workforce, precision manufacturing in electronics and automobiles, and innovation in quality control. These elements enabled gradual rebound, illustrating how intrinsic capabilities buffer against financial shocks, though not without prolonged societal strain. In the United States, the 1929 stock market crash further demonstrates this principle. The Roaring Twenties, marked by technological advances like automobiles and radios, fostered a credit-fueled euphoria. Speculators, from Wall Street brokers to Midwestern clerks, margin traded aggressively, building fortunes on borrowed optimism. Bankers extended loans recklessly, ignoring risks amid prosperity's illusion. When overproduction and unequal wealth distribution culminated in Black Tuesday, values evaporated, triggering the Great Depression. Farmers in the Dust Bowl lost homesteads to foreclosures, families endured breadlines, and the unemployed wandered in search of work, their hopes crushed by systemic failure. Recovery hinged on New Deal reforms and World War II mobilization, but survivors often were those with practical trades or community networks. Factories producing necessities rebounded, emphasizing that utility-driven assets endure. This event's long shadow influenced global regulations like the Glass-Steagall Act, aimed at preventing recurrences, yet vulnerabilities persist in today's leveraged markets. Extending this to contemporary implications, economic systems often prioritize illusory metrics over substantive foundations. Currencies, stocks, and real estate derive strength from collective faith and policy decisions. Susceptible to central bank interventions or geopolitical shifts. In 2008's global financial crisis, homeowners discovered the peril of debt-backed assets. Subprime mortgages, packaged as secure investments, collapsed when housing bubbles burst. Families faced evictions, their sense of security shattered, while traders who overextended on derivatives grappled with regret and ruin. Governments bailed out institutions, but ordinary citizens bore austerity's weight, highlighting power imbalances. True security emerges from diversified value forms, expertise in indispensable fields like healthcare or agriculture, ownership of revenue-generating tools, or robust social ties that offer support during downturns. Historical precedents show that skills enabling adaptation, be it Roman artisans pivoting trades or Depression-era entrepreneurs innovating outlast volatility. Ultimately, distinguishing wealth from value demands recognizing that financial figures are claims on resources, not the resources themselves. When underlying supports erode, as in debasements or bubbles, the fallout affects leaders and laborers alike, breeding uncertainty and reshaping societies. By cultivating resilient elements, productive capacities that address perennial demands, one mitigates risks inherent in external systems. This approach, informed by centuries of economic ebbs and flows, empowers individuals to navigate uncertainties with grounded foresight, ensuring prosperity that transcends fleeting metrics. For more deep, carefully researched stories from economic history, subscribe to our channel, Einstein of Economy.